Today we're discussing the student loan interest deduction and whether or not you can still claim it. Before the COVID-19 pandemic, many taxpayers took advantage of this deduction, which allowed a maximum of $2,500 a year in interest payments to be deducted from their private or federal student loan. Sadly, due to the coronavirus pandemic, those who had opted for federal student loans have found the deductions no longer applicable to them. Due to the Department of Education allowing the majority of citizens with federal student loans to pause their payments without interest accruing, interest has not been paid and therefore the deduction is not possible. However, as stated by higher education specialist Mark Kantrowitz, those who owe any other type of loans other than federal student loans may still able to receive deductions, provided they've made interest payments, and as long as their income doesn't exceed the phase-outs of $85,000 for individuals and $175,000 for couples. These deductions can be tracked through the tax form known as the 1098-E, which is sent to the IRS and to you. Depending on your income earned rate and the amount of interest you paid, the maximum deduction you receive could be up to $550 annually for each year you're eligible. It's important to note that whilst those who may receive loan forgiveness may worry about potential tax implications, the Department of Education have clarified that debt forgiven from the Coronavirus Aid, Relief and Economic Security (CARES) Act will not be taxable. Ultimately, the best way to discover if you're eligible for a student loan interest deduction is by contacting your loan servicer and asking for clarification. It's important to be aware of the tax implications at play when managing your loans, so make sure you're up to date with the latest legislation.